Good morning, ladies and gentlemen. Great to have you all joining us for a fantastic session this morning. We will cover so much of what is current, relevant, and very topical in the media and with your clients. We have Jurgen Skuman joining us from ID Capital, and he will cover changes to US exceptionalism and the opportunity it creates for SA fixed income. We all know that fixed income funds worked extremely well for clients over the past few years, but where does it fit into client portfolios going forward? And how does the ID Capital BCI Income Fund capture these opportunities? We're also joined by a formidable global equity manager, Tony Bell from Thinkcell. And Tony will look at a lot of these topical things like the S&P concentration risk, US bond yields, the dollar. I know there's lots of questions on that. The path of US inflation and recession or not, and understanding the Trump framework and so much more. And more specifically then, how does this all come together in one of the most consistent, top-performing global equity funds, the MyPlan Global Macro Fund, and I'm sure you're all very well aware and versed with this fund. Good morning, Jurgens and Tony. Thank you so much for joining us this morning. How are you doing?
Hey, Eugene, good. Thanks for the opportunity.
Yeah, fantastic to have you with us. Jurgens, you up first. You can start sharing your presentation to our audience. Jurgens will be followed by Tony. You know how it works by now. Q&A bubble. If you have any questions for either Jurgens or Tony, please post it, and we'll try to cover as much of it as we can after both presentations. Jurgens, I can see your presentation absolutely clear. Thank you so much.
It's in presentation mode on your side.
Yes, perfect.
Well, good. Thanks again, Eugene, for the opportunity. So today we're going to talk about ID Capital, specifically ID Capital BCI Income Fund. So what we start off here is with on the right is the Vince Lombardi Trophy. This is the pinnacle of American football, and to illustrate how we think about portfolio management and construction of this fund, we will use an American football analogy. I mean, the alternative was to use rugby, but fixed income is usually a bit foreign to most people. So we have to go with the American football theme here. So the trophy itself was designed by a Swiss jeweler who knew nothing about American football. His simple design resulted in a football basically mounted on a box of cornflakes. So with this presentation, we'll attempt to break portfolio management and construction of our income fund for you down into simple terms. So the IE Capital Income Fund is in the multi-asset income fund strategy. We use a building block process for portfolio construction. And the agenda and the overview of what we're going to cover today is probably it sits around four basic sections in this deck. So what we do, how we do it, and the basic principles we employ to do the how. And then a couple of portfolio themes, one that Eugene pointed out earlier in terms of US exceptionalism and how we see that play out as an emerging market opportunity. And then we come to the last section of proof is in the pudding, or is it? But that's for you to decide, and we'll get to that at the latter stages of the presentation. So when you think about American football and how this analogy plays out in fixed income, American football is a game of strategy. I mean, there are 46 players on the field. There are 46 players eligible to play on game day. Of those, only 11 can be on the field at any given time. So it's quite long. I lived in the States. I watched a couple of these matches. There's lots of strategy that goes into that, probably more so than rugby. But we're not here to provoke controversy, rather to provide insights into our portfolio construction framework. So ultimately, the contest hinges on tactical precision and long-term strategy, and that's important, especially important in this fixed income strategy that we employ. So when you break up those players that's on the field, they basically in that team they break down into three different teams. There's defense or the blockers. In other words, the guys that no matter what they'll be there. They'll block the offense or the attacking side from coming through your defense. Then you've got special teams, in other words, the kicker, and then you've got the crazy oaks or the rock stars, and they're on the offensive side. So they're the guys scoring the goals and or scoring the touchdowns. Incidentally, in American football, you just have to cross the line. You don't actually have to ground the ball. So there's different strokes for different folks in American football. But ultimately, what we want to highlight here is that from a special teams perspective, special teams can be employed either as an offensive or a defensive line. So you think about if you think about this guy here, he's kicking the ball. So he's actually kicking for possession. Sorry, he's kicking for territory. So he's kicking for territory because he wants to get out of the defending half. But special teams also play the role of attack. So when they convert goals, or special teams are also employed when there's a play from the kickoff. So sometimes they actually also score goals. So what we're trying to illustrate here with the special teams is there's offensive capabilities and there's defensive capabilities. And the fun fact is that in the National Football League, special teams account for about 35% of all the points scored in a single season, which is a great attribute where you can use something in the middle that can give you both offensive and defensive capabilities. From portfolio construction and the portfolio building blocks, this is how we see this come together. So if we convert this to the financial instruments and products we use, you can see the defense or the blockers would be money market instruments. We also use credit. On the credit side, we use a couple of funds to get that exposure for us. And then the special teams where you've got where we use interest rate linkers, for example. So interest rate linkers got defensive capabilities. It's less volatile than fixed rate bonds, but then it's also got offensive abilities when break-even inflation, when realized inflation is higher than break-even inflation, we can actually provide offensive capabilities. And that's how we see this come together. On the offensive side, in other words, where the rock stars live, this is where we got fixed rate bonds. So fixed rate bonds gives you that it currently clips at a higher yield than floating rate bonds, but also it gives you that capital upside from a portfolio management perspective. So this one is just a quick overview of the subcomponents of the efficient frontier. On the far left, you get the mattress money or money market instruments, and on the far right, you get fixed rate bonds. So we use this the building block approach to build a diversified portfolio that's going to give you long-term potential, but then also it can withstand short-term volatility and it gives you that long-term upside. Moving on to the next section in how we do it. How we do it is quite important. The reason it's quite important is because from a fixed rate bond perspective, there's capital variability from that fixed rate component if you invest in govies. So the two principles we really take seriously and live by day in and day out is two Buffettisms or two rules of managing money. In other words, never lose money, and rule number two, don't break rule number one. And that plays out in known and unknown risks. So when you think about risk management for this portfolio, there's known and unknown risks. And in managing known and unknown risks, from a fixed rate and duration perspective, there are times where you want to be protected. And the way from a known risk perspective that we've managed that risk is leading up to the US election, we've actually taken some risk off the table. So you go in with less duration because what you don't want from a fixed income perspective and a return perspective is volatility. In other words, sawtooth returns. So permanent loss of capital is really important to be cognizant of that. This is an illustration of an unknown risk. So in other words, Liberation Day, and the way the portfolio held up better than some of the peers that is out there and then manages a portfolio or a fixed multi-asset income portfolio on a similar basis that we do. So you can see there was downside protection that because of a hedge position that we did have, and then there's also upside return. So we're capturing, protecting there on the downside, but then we're also capturing on the upside. And then interestingly, some of the portfolio themes that's either played out or that's top of mind at the moment is very topical for this discussion. So in the next section, we'll cover some of those portfolio themes and things that get us really excited. So from a return perspective, the drivers of return, and then also the drivers that take away return. So I really like this slide. This slide is one of my favorites in the deck because I think it talks to a lot of what's played out over the last couple of months in the world economy, specifically US, but then also South Africa. So on the left, we see the end of US exceptionalism and the turbulent headwinds that's prevalent in the moment. So this is from Apollo's mid-year outlook. And it neatly summarized the changing landscape in the US exceptionalism. I mean, you can go through those bullet points. The point we're trying to make is this actually presents a great opportunity for South African fixed income. The reason for that is we'll dig into some of these things, but essentially there's stable and growth conditions loading and corporate confidence increasing and the inflation environment, inflation targeting by the Reserve Bank changing, and all of that presents and supports fixed income portfolios. This is a very basic slide, but it's quite important in the bigger scheme of things, especially in the bigger South African economy. There's incremental signs of structural progress in the South African economy. This is essential for improvement to increase the economic growth rate. I mean, you can see on the left, port productivity, freight volumes, especially coal and iron ore are recovering. So the Kumba Iron Ore mentioned this in the results. Kumba Iron Ore produces high quality of iron ore, and because of that, because of increased efficiency in Transnet's efficiency, they could actually realize higher sales numbers, and that supports your growth story or your growth basis. From the freight volumes. Sorry, I was just at freight volumes. Port productivity has improved around 20% year to date. This manifests in reduced wait times for vessels at anchorage or berth, and that's where you see the grey line trending downwards. The last one to the far right here is Eskom is able to keep the lights on, and we've seen load shedding largely absent in 2025 year to date. But the point we're trying to make here is by addressing these structural constraints, it lays the foundation for stable and increased GDP growth in South Africa, which is supportive of fixed rate bonds. This is on the far left. On the left, you see the SACI Business Confidence Index. You can the yellow areas are denoted by downward phases in the business cycle. This is important because because ultimately according to Nobel laureate Robert Shiller, economic narratives influence decisions that ultimately shape the economy. If we move to the extract on the right, what the Bureau of Economic Research in Stellenbosch have done here is they've overlaid a higher frequency data index, in other words, new sentiment on that SACI Business Confidence Index. And you can see it has higher frequency data because it uses a group of selected financial publications and outlets. But ultimately, the red and the green, the red and the blue fit together, and that points for us as South African business to continued progress and upward trajectory. The reason for the South African Reserve Bank and some of the reasons that they are taking the view to change the inflation target is because we're currently in the benign inflation environment. The problem we have with high inflation is it's a tax on everyone. It's a disproportionate tax on the poor because a larger bucket of the poor's disposable income goes to basic goods, and it reduces return from a fixed income perspective. But against this backdrop, as the South African Reserve Bank has seen this as an opportunity to change the inflation target from a midpoint of 4.5 to a point target of 3%. and they want to anchor inflations at this lower level. So the challenge they have at the moment is they don't have buy-in from National Treasury, but it's a work in progress. Incidentally, National Treasury, Minister of Finance a couple of years ago, they did the very same thing when oil prices were low. They increased the fuel levy. So it's you always have this this content sometimes from a short term and a long term perspective. National Treasury thinking short term, and South African Reserve Bank thinking long term. And it's always so National Treasury didn't actually ask Reserve Bank if they can increase the fuel levy, then the Reserve Bank just has to deal with the fuel levy on the other side, which increases inflation. Then we get to higher real rates. So South Africa, it's one of the countries in the world with the highest real rates, Brazil and Mexico being some of the others. But higher real rates tighten financial conditions and slow economic activity. We refer this graph as the Table Mountain Formation, and you can see that the white line there, nominal rates minus the real rates at 3, get you to around 4 at the moment. From a proudly South African perspective, and Tony's probably going to talk to this, but we want to see the Table Mountain Formation, in other words, higher real rates that stifle economic activity, to move towards the water, to move towards the waterfront. In other words, real rates trending downwards to stimulate economic growth and gross fixed capital formation. In other words, provide an incentive for business to invest in capacity so that we can grow our economy. The challenge, though, with lowering the inflation target is that there are structural constraints that limit South Africa's Reserve Bank to control inflation. Administered prices such as electricity, water, and fuel make up 30% of the CPI basket and has consistently outpaced headline inflation. Those factors are primarily outside the scope of monetary policy. So if you look at this graph, if you look at this table, the impact of a $10 increase in a barrel of oil, you can see the impact on inflation is around between 0.3 and 0.4%. This was modeled on a midpoint target of 4.5%. And if you look on the right, the growth impact is around minus 0.15, minus 0.2. The challenge for the Reserve Bank, and this is where some of some market commentators questioning the fact that can we actually afford a lower inflation target, is because it could have a detrimental impact on private capital formation in an already low growth environment. So there is risk of execution for the Reserve Bank and in going for the lower inflation target. And to combat this, or to take this into account in the portfolio, we use the special teams. In other words, we use linkers. So in an uncertain environment where, although in a downward trending inflationary environment, you still need to use linkers or have that protection. So we get to the last section now. Is do we actually is the proof in the pudding? So when we look at the return contribution over the last couple of years, and we split this down into your offense, defense, and special teams unit, you can see that the black dots indicate total return, the gold bars is your coupon, and then the green bars is your offense, in other words, your fixed rate capital appreciation component. And you can see that over time, there has been quite good returns from this fund and a good steady interest component or a running yield. And then this is supplemented by the green bars and also the special teams. So if you look at the black dot between March and September 22, you can see that from a total return perspective, this quarterly return graph over a 3-year period, that return has been it's minus 0.04. So from a total return perspective, over this period of time, the fund has done really well. We just on this graph, we break down the return contribution over since inception of the fund, or sorry, for the last 5 years, against STEFI and CPI. And then this is where it's really important for us to show that there's proof in the pudding. In other words, consistent top quartile performance. You see over a 5-year period, there were 95 funds in the multi-asset income sector, and we did really well there. Then over a 1-year period, we are 17 out of 137, still steadily in the top quartile. But then you can see that there's much more funds, 137 funds in that period. And from an annualized return perspective, you can see that since inception, the fund has done 8.6% over 1, 3, and 5-year period, decent returns. Where do we see the ID Capital Income Funds fitting into your portfolio? When we model this against the ASISA low equity multi-asset asset class, you can see that on the far right, this is ASISA low equity. On the far left is the ID Income Fund. So for the same level of return, for the same level of risk, you can realize the same level of return and move to the left on the efficient frontier. So any combination then of a CISO low equity and the ID Income Fund gets you to move towards the left. In other words, stable, steady return and lower standard deviation of return variability. So where do we fit in as your special teams unit? So as a building block to your portfolio fund solutions or problem solving for asset allocation. And getting back to the Vincent Lombardi Trophy. So it's actually manufactured by Tiffany's over a 3-month period, and the winning team gets to take it home. It takes quite a while to do this, but it's manufactured by a reputable institution. So there's proven top quartile performance across all periods. We positioned for EM excellence. There's limited downside with good income and a running yield, and you can use it as a building block for superior portfolio construction. In American football, champions are made by having the right strategy, flawless execution, and being positioned for the next play. The ID Capital Income Fund then delivers on all of those three. And that's my story. Thanks, Eugene.
Yeah, thank you so much. What a fantastic way to present the fixed income fund. You've done a superb job. Thank you very much for that. I've got a couple of questions for you, but first up, we've got Tony. Hey, Tony, we're ready for you. If you can start sharing.
Thanks, Eugene. Right.
Yeah, got your presentation. Perfect.
Morning, all. Thank you very much for the invitation, Eugene. And thanks to everyone who's on the call. I think many of you are familiar with the fund. So I'm just going to spend a very brief amount of time updating you on performance and then really get into some interesting questions. The theme of today really is to look at, are we in a bull market or the beginning of a mania? And how do we manage all the myriad of responses from Trump on a daily basis? I see last night he was upset with the Goldman Sachs economist who forecast an increase in inflation and wanted his services terminated. So we're getting a pattern, and hopefully by the end of the talk, I can provide you with a little framework to take away and answer that central question, bull market or mania. I thought for the purpose of today, 10-year retrospective. It's been a very good run. We have constantly outperformed the peer group benchmark. The fund has won a number of awards. And I think most importantly, the fund has served the interests of clients in the global flexible space. It is an 80-20 fund. It's not a pure equity fund. We're benchmarked against 80% MSCI, 15% dollars, and 5% cash. So it allows the team at Thinkcell to operate in a more flexible environment. If you're trying to get a feel for the fund, its ups and downs, because it's typically a high beta fund, it does very well in growth markets. And then with various techniques, we look to try and protect the downside in down markets but that is the period where you have drawdowns in the market where beta does poorly, as we had in April of this year. Here's the relative return. It's done quite nicely and consistently, and I think that's what clients are looking for. If we look back past year to 10 years, the fund sits consistently in that upper quartile. We do go through periods, as we went through in April and May, where you will see third and fourth quartile, but those typically tend to be short-lived, and they really function of the construct in the portfolio. We run high beta portfolios with cash as the buffer. When the market does a big drawdown like April, the beta stocks suffer more and the cash doesn't quite buffer it sufficiently. And that's just one of the risks that we need to manage in the portfolio. So let's have a look at the macro positioning and the environment. I spent a little bit of time at the BCI conference recently in Pretoria going through this. And this is a very important framework to understand. It's now fairly well known, but worth going through it again. It was a paper that was delivered by Stephen Mirren, who is core to Trump's economic advisory policy. He published the paper in November 24. You can download it off the web. It's well worth reading. And the basic argument says, the US as the reserve currency has got a burden to keep on supplying dollars to the rest of the world that it grows, as it grows. And as a consequence, that places a burden on America to keep on supplying surplus dollars to the rest of the world. So in Mirren's analysis, there were two problems to be solved. The one was trade deficits. They're a bad thing. We hear that from Trump all the time. And the second one was because of this constant demand for dollars, the dollar was overvalued, and therefore we needed to go into an environment of dollar devaluation. Mirren concedes in the paper that he doesn't quite know how the dollar devaluation would work, and somehow folk have convinced Trump that either he convinced himself or someone convinced him that tariffs are paid for by foreign countries. No, they're not. The current estimated apportionment is that 15% of tariffs are being absorbed by the offshore manufacturer, about 40% by the US importer or company, and the balance by the consumer. And I think the drift of today's presentation would be to try and assess how much of that tariff absorption is going to continue to be met by the companies, or whether consumers will face an increasing proportion of the tariff that's now implemented. So that's the framework. What does it look like in reality? The market has started to move short the dollar. The gray line is the dollar itself, the US dollar index, and the shaded area is net long short positions. So you can see that whereas in 2022, the market was quite long dollars, the market is now quite short dollars. What's the impact? It's actually a good tailwind for S&P 500 companies. About 45% of companies translate foreign earnings into dollars, so weak dollars good for them. Clearly, Trump is pushing hard on exports. Don't think manufacturing, think services, think NVIDIA. Weaker dollar helps them quite significantly. And clearly, in a fairly unprecedented move, he would also like a share of that revenue, Q NVIDIA and Q AMD. Importantly, the bond market. What is the bond market telling us? And I think to follow from the previous presenter, one's got to try and figure out where the next play is. The bond market is telling us that at the short end of the curve, interest rates need to be cut. Why do they need to be cut if growth is doing so well and inflation is falling? There's a little bit of a paradox there. And why does the market steepen so dramatically at the long end of the curve? Is there a lot of term premium being built in? Yes, term premium is a simple technical term that is used to say, well, in case we're wrong about inflation, and the risk that we're assuming is implicit in the funding risk, what sort of premium do we build in? And our assessment is that at these sort of levels, the market's starting to build increasing levels of term premium into the long end of the curve. Remember also that under Yellen's watch, there was something in the order of 7 trillion in T-bills that were issued right at the short end. Those have now risen to 9, and Scott Bessent, the Treasury Secretary, has to refund them. And I don't think the bond market is that willing just to absorb that level of issuance. And certainly if he funds them along the long end of the curve, it's going to be more expensive. So it's an interesting point to ponder. Trump is calling for interest rates to be cut, but that's only at the short end. What would happen at the longer end, because all the mortgages and all the long-term funding hinges off the 10 and 20-year part of the curve, not the 1 and 6 month part of the curve. So we'll wait to see how that plays out. Scorecards are interesting. It depends on how you represent them. This is Trump's scorecard so far. So when you hear all the jawboning about markets at new high and you set it in this context, he's not doing so great so far. This is an interesting chart to take away because you can see under Clinton's first period, 14.5, Obama 14.1, Hoover, Roosevelt. Trump's really only beating Bush and Reagan. So it's much yardage still needs to be covered before Trump can claim greatness on this score. What's interesting me at the moment is the number of fresh new peaks across different markets. Now, if you cast your mind back to the pre-Trump era, Biden put in the CHIPS Act, the Infrastructural Development Act, and the Inflation Reduction Act. Somewhere around about 3 trillion got injected dollars into the US economy and by extension into financial markets. And so part of our thinking is to watch the flows. Typically bull and bear markets. Bull markets start because inflation starts to fall, interest rate expectations drop, we've got that, and earnings are solid and economic growth will improve in a way that can sustain earnings and sustain the bull market. Bull markets paradoxically end when something goes wrong with the first two variables, or the third, but mostly it's the first two variables. There's some inflation shock, or there's some structural break in the liquidity cycle. Now, what's focusing our mind at the moment is not just the inflation and interest rates and earnings numbers that Wall Street is focusing on, but really the liquidity cycle. I think this is my 40th year in investments, and almost all the bear markets I've been through happened because of a break in a liquidity cycle. The transmission mechanism is something happens to a currency, something happens to a market where there's a liquidity. Think back to 2008, 2009. We've got a liquidity crunch in something. Investors try to get out. There's not enough liquidity and prices start to fall. So what this interesting graphic shows you is that there's just quite a lot of highs developing. And we just need to be cognizant in the context of the debate between bull markets and manias that a number of markets are seeing highs. And those are all fueled not just by Trump's big, beautiful bill, but the liquidity injection of the previous administration. We're well familiar with the concentration in the S&P 500. I thought this was an interesting schematic. You can see how much NVIDIA has dominated the growth in the past 5 years. And these companies now make up about 38% of the S&P 500. So what happens in these companies matters a great deal. This is a graph that I hope does give you reason to pause for a moment. What I've done here is I went back and I charted all the previous manias. The 1980 gold rush, Japan, remember the market hit 44,000, ended up at 6. They're absolutely dwarfed by Bitcoin and the FANG stocks. Bitcoin, I must confess, maybe I'm getting a bit too old, but I just don't understand crypto. I get stable coin. I understand everything to do with tokenization. But the liquidity within the crypto markets is running very, very hot. and they're leveraged, and they're significantly leveraged. And so I would point out in the context of today's presentation that we have two markets, the concentration in the S&P 500, the broad-based liquidity leading to all those highs that I've shown, and the various crypto markets, Bitcoin being an example, where we have dwarfed previous manias. And I think our read through is it's how liquidity and the macro fundamentals link through, and whether we have a structural break in any of these high-flying markets that would cause the underlying economic metrics to suffer. So when we have a look at inflation, good print yesterday, 2.7, but that's rear view looking. On this particular chart, you can see in the black line, US CPI, and then I've overlaid the price plans for the next 3 months for small businesses in the US. And I've picked them specifically because they're the most sensitive to price increases. Big companies do have higher margin. If you look at the 11 gig sectors, 8 of those 11 gig sectors are controlled by the top 5 companies in each sector, and they have significant margin advantage over their competitors. They're dominant, and they can absorb a lot more, but the small businesses can't. So I think we've got to watch carefully to see to what extent the pricing pressure comes on small businesses. And where's that pricing pressure going to come from? To the previous speaker's point, this is an interesting chart showing you on the left-hand side which categories of goods, they're not very high in the CPI, but they're very high in people's lives in terms of apparel, women's, men's, sporting equipment, recreational toys. They're all advancing, not at 0.5 or 0.7% per month, but they're advancing between 1.5 at the top of the table and 4.5 at the bottom. And that's a month-on-month increase. Trump has played with this tariff story, obviously as a negotiating tool, a leverage, if you want to be polite. I would call it a sledgehammer. And we're now getting to the point where some of the chickens are coming home to roost. Inventory levels that have been built up are going to start to draw down, and these cost pressures are going to come through because he genuinely sees it in terms of the Triffin paradox, in terms of the Mirren paper, as a source of revenue. He's not going to negotiate this to zero. 10 to 15% is his baseline, and if you don't toe the line, well, you get a higher tariff. Why would Switzerland be at 39%? They run a trade surplus with the US. So there are a lot of hidden issues around these tariffs. Could we be dealing with a recession in 2026 in the US? It's quite possible. How would it play out? You're starting to see more than 50% of companies in certain surveys starting to weaken their jobs data. It's very early term. Small businesses under massive margin pressure, increasing their prices. Consumers don't quite know where to go. They're not feeling comfortable with their job security. And certainly if you look at it cross-sectionally, many of the service industries, which comprise 70% of the US economic structure, are supported by let's just sort of say lower paid workers. And those lower paid workers are unquestionably under threat from the various policy, if you can call them policy, initiatives by the Trump administration. So you've got a destabilized market at the lower end, and that could cause problems. And what this shows is that where your unemployment rate has a move of 50 basis points or more over a rolling 6-month period, it could start to create the conditions where the labor market softens, and as a consequence, companies start to lay off and we move into pre-recessionary conditions. And then, Eugene, just to finish off into the last 2 slides, it's comforting at this stage that earnings have been revised upwards. We would point out that they're off a much lower base, because when the market collapsed in April, analysts immediately downgraded their earnings. So there are good segments of the market where earnings are being revised upwards. But I just question whether Trump's various initiatives are going to be good enough to sustain an economic environment where you have growth being more broad spread. The rise that we've seen in this equity market has been very concentrated to industrials and techs. We're seeing companies like Eli Lilly drop significantly in price, Hermes, all the bellwether stocks of economic activity have softened, whereas tech and specifically industrials have moved ahead very strongly. And you've almost got this polarization in the market. The last factor that we would draw to your attention in the presentation is volatility. So it's a bit of a complicated chart, and I apologize for its messiness. The black line is equity risk premium inverted, which at the moment is 0. There's no buffer in the equity risk premium. And the pinkish colored line is volatility. So how we link this together, we have a significant liquidity buildup. We've seen that. A number of markets have hit new highs. We've got leveraged price gains in crypto and probably in certain FANG stocks. The excess liquidity has for the time being dampened volatility. And if we start to find erratic price movements in those leveraged markets, it could well create volatility spikes. And where we have a volatility spike like we had in 2008 and 2020, equity risk premiums, the black line, increase significantly, price earnings multiples drop, and that feeds through with all the macro factors that I've spoken about into the real economy, where we're starting to see a few signs that we need to watch: rising inflation, weaker jobs market, etc. And so, Eugene, just to finish off, how have we positioned the portfolio? I sit in many presentations where I see the top 10 and I can't see the portfolio, so we've just given you the whole portfolio. What we've got on the vertical axis is how much active risk we're taking in the stock. And on the right-hand side, we look at our horizontal axis, we look at our active positioning. So you can see there's sort of 3 areas of the chart. In the top right-hand corner, you've got NVIDIA, Netflix, TSM and Palantir, Taiwan Semiconductors. PLTR is Palantir. And then in the middle, you've got a whole bunch of dots that really are the core holdings. And then off on the left is the underweight in Apple. So the way we've positioned the portfolio, just in closing, is we've really positioned it on what they call a barbell approach. Our high conviction, high growth stocks are in the top right-hand corner: NVIDIA, Netflix, Taiwan Semi, Intuitive Surgical, GE, Vernova, and Palantir. We've underweighted Apple. We've got a lot of cash, and essentially we're riding the up market, but we're looking to protect the downside because we do see some signs that start to elevate the risks in our mind. Eugene, I will thank you and end off on that note.
Tony, thank you so much. You've covered a massive amount of ground, and to people that have given me understanding where we are, or do we? Tony, maybe just 1 or 2 questions from my side. That I mean, you've spoken about the earnings revised upwards, but people are still saying that US equity markets are expensive. Your views on that?
It depends on how you segment the market, Eugene. If you take away those magnificent 7, the market's really not that expensive at all. Set in the context of an interest rate environment that looks like it's going to fall, lower interest rates support the equity market, earnings growth that's being revised upwards. We don't see excessive valuation in the US equity market. I think this notion that sort of APE is a representation of cheap or expensive seems to miss the most important part of the Benjamin Graham valuation formula, or price to book. You've got to have a look at your return on your equity, your cost of equity, and your growth. And I think at the moment it really all hinges on how that growth rate is changing. And part of the reason why we've seen this incredible volatility is that the market is struggling to come to terms with what companies' sustainable growth rates are. Simple example, if you picked Colgate, Colgate will grow at 8 to 12% per annum. And, that's sort of pretty much baked in like a Woolworths, because the structure and the nature of the company doesn't allow it to do much else. Now you throw import tariffs at it. What's that growth rate going to do? NVIDIA, you ban sale of chips to China, and then you cut yourself a deal, and now you can go and sell your strategically important chips to China with a 15% cut to the US government. We're in a new world. And so the market itself, I think, has a much bigger job to try and establish fair value across a range of sectors than just looking at the aggregate PE. So from our perspective, we would always caution just looking at a PE and saying it's expensive, because there are so many components that go into making up that PE.
And you're 100% right. I mean, PEs are a bit of a blunt tool. You've got to look at the opportunity set and, like you said, return on equity. One of your very first slides when you spoke about the dollar, it was interesting to see how markets are to some extent shorting the dollar. It also does explain dollar value decreasing. But do we read more into that? Do you see a trend that markets are disinvesting out of the US or investors and looking for other opportunity sets like Europe or even places like Japan and who knows, China?
Yeah, that's a great question, Eugene, because I think if you look at the sort of general narrative, it is that the US has become less investable, and I've seen a lot of fund managers in the global space moving to Europe and moving to Japan, moving to China.
Yeah.
I'm not sure it's that simple. I mean, I make an outrageous statement. If Trump actually gets this right, the US could become spectacularly successful, because the incentive to invest and redirect capital back into the US, with one of the most sophisticated service infrastructures in the world and one of the most dynamic markets, does potentially create a game changer. I'm just not sure with the way in which he's gone about it that it will sustain itself. Let's take an example, Apple, Tim Cook. It is not in Apple's interest in any way to manufacture in the US. They manufacture in India, they manufacture in China, and the US actually benefits significantly from that cost advantage. The cost advantage of manufacturing offshore has created this thing called US exceptionalism. If you look at most exceptional US companies, they've been able to export their cost of production offshore to a lower cost. And what America's done very successfully is they have imported cheap labor to create US exceptionalism in the services industry. So the US is a significant manufacturer of services, not goods, whereas companies that are owned in the States, like NVIDIA, have been able to enjoy benefits offshore, and Apple. So what does Tim Cook do? It becomes quite a difficult decision to relocate capital from where it's best employed to the States, because ultimately your return on equity is diluted. You cannot run the business in the US as efficiently and as profitably as you can by having your manufacturing in India and your retail market in the States. And I think this is the dynamic that folk are struggling with. But I wouldn't, to your question, write the dollar off, because there's a lot of incentive being created for companies to do business with the US. It's just been done with such a sledgehammer approach that the adjustment process is very staccato-like. Companies are just not used to this sort of planning. Biden, by the way, did try and create the same environment more subtly. The CHIPS Act, the Infrastructure Development Act, that incentivized a lot of companies to come to the US. Trump just has a far more direct approach. But I think calling the end of the dollar is premature.
Very interesting indeed. Um, just with regards to the dollar as well, and looking at people selling out of the dollar, we've seen some of this happening last year. Do you think we can still see a further unwind of the Japanese carry trade?
Yeah, it's quite possible. I think Japan is in an interesting position. Their inflation rate's gone up to 3% odd. And of course, for those on the call, what would typically happen is Japan had yield curve control. And a little while ago in 2023, we noticed that the market was starting to break that yield curve control. In other words, when it went above the upper bound, the Bank of Japan had to step in and buy JGBs. And as a consequence, the yen expanded, more yen were issued. And so the weakening of the currency went hand in hand with the weakening of the bond market. You're now sitting at a situation where the carry is not that attractive on the interest rate in Japan, and the dynamics of the yen flow are quite different given that there's no longer a one-way street in the issuance of the yen. So I think that part of the complexity of the yen-dollar relationship is that carry trade has already started to unwind, and that has reduced some of the availability of, call it, cheap currency to the rest of the world to play their carry trade. And I think if you go back to the start of 2023, the reason why we were very heavily risk on, and recall in 2023, there was a lot of talk about recession, deep recession, and the market at that stage being very overvalued. Nvidia in 2022 in December had dropped by about 25%, and it was a very gloomy outlook. So to go risk on at that stage in the fund seemed a little counterintuitive, but what we'd seen was the break in the yield curve control in Japan and the issuance of yen, which flooded liquidity into the market. And I think that's one source of liquidity that's been removed from the market now. So I think, Eugene, that one must always just look at singular indicators with some degree of circumspect, because the system is quite interlinked. And, that's why I look at it in terms of price momentum to peak, because wherever the liquidity source is, the carry is coming into things like Bitcoin, crypto, FANG stocks, large leveraged positions. And that pretty much what undid the market in 2008. And it comes from a source that and at a time, you just can't expect. So there's a little hiccup, and the little hiccup leads to a seizure in liquidity, and those trades, wherever they come from, unwind. And so you start to get these transmission mechanisms that are beyond the scope of normal market activity. And that's where you have accelerated volatility and price movement. It happens very slowly, and then it happens quite quickly.
Sell your cryptos and buy the global macro fund, but we'll park it there. Tony, I know Jurgen's also waiting on the line. There's a couple of questions for him, but before we go over to Jurgen's, maybe two questions very briefly relating to your fund. The one comes from the audience. What is your current cash holdings in the fund, and in which currencies is it held? And then a second one relating to the fund as well. It seems like you are having, or you do have a bit of exposure to MSCI Eurozone ETF through an iShare. Does it mean that you're also looking a little bit more towards Europe?
Two great questions. Cash is sitting at about 18% at the moment. Some time ago, we shifted the cash away from dollars. We hold the bulk of that in euros, pounds. We introduced gold into the portfolio. We've held US long bonds and US short-dated instruments. So approximately half of our US cash is sitting in JP Morgan short-term income fund. We hold some US long-dated bonds through an ETF. And quite right, to the European question, we moved at the start of this year, we did quite a big reallocation from some of the traditional positions we'd held in the portfolio, which would be US growth oriented. We increased our European ETF, we increased our Asia ex-Japan ETF. We bought into Siemens and Deutsche Börse and Rheinmetall as specific exposures in Europe. We do hold quite a big position in Barclays PLC as a sister stock or a companion stock to JP Morgan. And so when we run global macro, we tend to run it according to a system known as IMAPs. Those that are familiar with the fund would know about IMAPs. Every stock lives in a certain part of the risk space. We look at companies across geographies in the same risk space and ask ourselves the question, how would we like to invest which company? How do we diversify geographies? And then how do we blend them? So we're also at the moment looking at more specific Japanese companies. We think there's been a great change there, and that would complement our position in the ETF.
It's only very interesting indeed. I can keep this conversation going for another hour, but unfortunately the clock is catching up with us. Thank you so much for your time this morning and sharing some great views in a very calm and collective way that you always do, and standing our clients very well in your fund. Tony, thank you. Jurgens, you've been patiently waiting on the other side. I do apologize for that. Just a couple of quick questions with regards to your fund as well. You spoke of the offensive rock stars in the fixed rate space, and again looking at fixed rate bonds or govies. Just translated to the ID Capital Income Fund, what is your duration at the moment? Is this still this time to have more offensive plays in the fund, or where do you stand?
I think it's a very good question, Eugene. So recently we've actually taken some risk off the table. I think chaos is only a tweet away with Trump, so it's a good time to be cognizant of the risks. But in the broader scheme of things, we build a robust portfolio for long-term investors to withstand both short-term and long-term volatility. So don't think it's a benign time to actually be adding more risk. So we are, I mean, you can look at forward rate expectations, and those have come down to one cut this year, another cut next year. So, I mean, 2 cuts priced in. The Reserve Bank wants, in the long term, it sees the nominal rate coming down to 6. I don't think that's going to play out soon. So, to me or to us, there's quite a bit of uncertainty. So we'd rather take the cautious middle ground approach rather than chase yield at any given cost.
Not the time to go guns blazing. On your defensive plays, you showed very clearly that consists of money market and things like floating rate notes or credit. Credit more specifically, I mean, we've seen credit instruments, the rates or the yields compressing significantly to some extent. If you look at some of the bigger banks, the yields are below that of govies. Your views on SA credit specifically, is that still an arena that is worth exploring, playing in?
So Eugene, that view we express through fund holdings. So on the credit side, that part of the building blocks, so we express those through fund holdings of the Ashburton Stable and Sasfin High Yield Fund. So we use those as building blocks. And when there is opportunity in the market for us to pick up yield enhancing credit, we will do that, and we will trade down on some of those fund holdings. But there is a very big stable component that is very beneficial to investors in this fund, where you can harvest that yield from those credit experts in the market. We also use the BCI Income Plus fund. So the combination of those three on the credit side to give you those inputs. Those yields have come down and compressed, but we'll take up some additional, but for majority those views expressed by those managers that we employ.
Some of your specialist plays, you've also mentioned ILBs, and we've seen some renewed interest in ILBs. Price entry point levels obviously being fairly attractive. Your inclusion at the moment of ILBs and holdings at the moment?
We've increased some of those recently. It's just more from a cautious approach. It's about between 4 and 5% of the portfolio. It's a very interesting argument, very interesting thing that you brought up, because you've got inflation going down or inflation expectations being tempered. So you could argue the other side of the question. Listen, what is in it for me if inflation is coming down? But that's actually the beauty of it. I mean, you can explore it as an offensive and a defensive play. We're using those as a defensive play rather than an offensive play at the moment.
Very interesting indeed. Jurgens, thank you so much for your time this morning. The clock really caught us this morning, and to our audience, apologies for taking the session a little bit longer, but I think there was some extremely valuable information that came from this, from Tony and Jurgens. Tony, thank you so much again. Jurgens, thank you so much for your time this morning. And again, for a fantastic presentation. I've yet to see an income fund being presented very interestingly as you've done. Gentlemen, thank you so much. We'll keep in touch and speak to the both of you in the very near future. Thank you so much.
Appreciate it. Thanks, Eugene.
Good stuff. To our audience, quick reminder, tomorrow morning we've got another hedge fund workshop, and you continue with our hedge fund sessions. The session tomorrow will be run by my colleague and managing director at Apex Investment Consulting, Pierre de Klerk. So Pierre, thank you very much for running with that session tomorrow, and sure to make for, again, interesting conversation on hedge funds. And then next week, Wednesday, we don't have boutiques on Wednesdays because we are starting with our offshore manager webinars. And that is a series of 3 webinars that will extend over the next 3 Wednesdays. And the BCI team, Tanya and Olga, again made for a fantastic lineup. So please make sure to register for that. And until I see you again next week, Wednesday, thank you so much for joining and your continued support. All these sessions are being recorded. I see there's a comment or question from one of your audience members, and it is on the Boutique Manager's website under Boutiques on Wednesdays. You can find all these sessions as well as the hedge fund sessions. Thank you so much again, and we'll chat soon.